Where's the gold going? Over the past decade, according to World Gold Council data and custom statistics, thousands of tons of physical gold have flowed out of Western vaults and into destinations that don't report their full holdings. Not paper gold, not futures contracts, physical metal, bars stamped with serial numbers, loaded onto secured aircraft, flown east, the exports are documented. The imports, in many cases, are not fully disclosed. Switzerland, the world's gold refining hub, imports gold from Western sources. They melt it down, recast it into smaller bars, preferred by Asian buyers, and export it eastward. The inbound shipments are tracked. The outbound destinations are often listed simply as Asia. Somewhere between Western vaults and Eastern destinations, visibility disappears, and that gap between what leaves and what's officially acknowledged arriving represents one of the most significant mysteries in global finance. While you were focused on stock prices and interest rate announcements, the oldest form of money in human history was being physically relocated across the planet, not traded on screens. Physically moved, tons at a time. London vault holdings have declined significantly. COMEX registered inventory has fluctuated dramatically. Swiss refineries are running at capacity, recasting Western bars into Eastern specifications. The destination is broadly known: East, China, India, Southeast Asia, the Gulf states. But the specific quantities arriving do not match what departs. Official reserve disclosures from major Eastern nations haven't increased proportionally to what's been shipped, which raises uncomfortable questions. Is China's official gold reserve figure accurate? Where are the thousands of tons that Switzerland exports to Asia each year actually ending up? Who is accumulating gold off the books, and why? The gold is real. The movement is documented. The destination is partially obscured, and the gap between what we can track leaving and what we can verify arriving grows larger every year. Now, let me be precise about what we know and what remains uncertain. I'm drawing from Swiss customs data, London Bullion Market Association vault reports, COMEX warehouse statistics, World Gold Council research, and official central bank disclosures. The export data is solid. Switzerland publishes detailed monthly trade statistics. The UK publishes vault holding reports. COMEX publishes daily warehouse figures. What's less solid is import verification. China doesn't disclose gold imports through all channels. Many nations report reserves infrequently. Private accumulation isn't tracked systematically. The mystery isn't manufactured. It exists in the documented gap between tracked exports and verified arrivals. I'm presenting what official sources confirm, where the gaps exist, and what historical patterns suggest about gold movements that precede major monetary transitions. By the end of this video, you'll understand exactly what we know about the Western gold exodus, where the gaps in our knowledge exist, and what historical precedent tells us about similar gold migrations. Because here's what most people don't realize. Gold has always moved before major monetary transitions. Always. Without exception. There's a documented pattern here. A pattern where physical gold relocates from declining monetary centers to ascending ones, where official numbers lag reality by years or decades, where the direction of gold flow predicts the direction of monetary power. Same sequence across centuries. Same institutional behaviors, same quiet accumulation before public acknowledgement. The gold that left Britain ended up in America. The gold that's leaving the West appears to be heading east. The pattern suggests we may be witnessing another generational shift in monetary power. The only question is whether you understand what the gold movement signals while it's still developing, or whether you'll recognize it only after the transition becomes obvious to everyone. Stay with me. The next 15 minutes will illuminate one of the least understood dynamics in global finance. To understand what the current gold migration actually signals, you need to understand how gold has historically moved before major monetary transitions, not randomly, in predictable patterns that repeat across centuries. Every major shift in global monetary power has been preceded by a four-phase gold migration pattern. This isn't theory. This is documented monetary history, traceable through customs records, central bank archives, and bullion dealer logs spanning 500 years. Phase 1, invisible accumulation. The ascending power begins acquiring gold quietly. Official reserves don't reflect actual holdings. Private channels absorb significant quantities. Government-linked entities accumulate without disclosure. The accumulation is real but not visible in official statistics. This phase can last decades. The incumbent power dismisses reports of Eastern or rival buying as insignificant. Official narratives emphasize the irrelevance of gold to modern finance. Phase 2, refining realignment. Physical gold begins flowing through refining centers for recasting Western specification bars, are melted and recast into specifications preferred by the accumulating power. The refining hubs become visible choke points where the flow can be partially tracked. Switzerland serves this function today. Swiss refineries import gold in large Western bars and export it as smaller bars with different specifications. The throughput data reveals the scale of movement. Phase 3, vault drainage. Visible inventories in the declining power's financial centers begin falling. Vault reports show persistent outflows. Delivery delays emerge. The physical gold supporting paper markets becomes scarce. This phase generates headlines, but is often dismissed as temporary or technical. The incumbent power's officials emphasize that gold remains available, that markets function normally, that concerns are overblown. Phase 4, monetary transition. The new monetary arrangement is announced or acknowledged. The ascending power reveals reserve holdings far exceeding previous disclosures. The incumbent currency loses relative status. Gold's official price or monetary role adjusts to reflect new realities. Those who accumulated during phases 1 through 3 benefit enormously. Those who dismissed gold throughout discover that monetary power has shifted while they were not watching. Now, let me prove this pattern is real. 3 examples, 3 monetary transitions. Same gold migration preceding each shift. 1890 to 1914. Gold flows from Britain to America. This example matters because it demonstrates how gold migration precedes the transfer of monetary hegemony, even between allied nations. Throughout the late 19th century, Britain was the unquestioned center of global finance. The pound sterling was the world's reserve currency. The Bank of England's gold reserves anchored the international gold standard. London was the world's banker, but gold was moving. American economic growth generated enormous export revenues. Those revenues, settled in gold-backed sterling, were increasingly converted to physical gold and shipped to America. The U.S. Treasury and private American banks accumulated gold systematically. Phase 1, invisible accumulation. American gold holdings grew for decades, not officially disclosed in ways that revealed the full scale. By 1900, the flow intensified. American banks began refining gold to U.S. specifications. European gold flowed through London, was converted, and shipped westward. The refining realignment was visible in Bank of England throughput data. Phase 2, documented in banking records. Between 1900 and 1914, British gold reserves stagnated while American reserves nearly doubled. The vault drainage was occurring, but London remained confident. The pound was strong. The empire was vast. Gold flows were dismissed as routine trade balancing. Phase 3, visible to anyone examining reserve statistics. August 1914. World War I began. Britain suspended gold convertibility almost immediately. The strain of war finance destroyed what remained of British monetary supremacy. By 1920, America held more gold than any nation in history. The dollar began its ascent to reserve currency status. The monetary transition that would be formalized at Bretton Woods in 1944 was already determined by 1920. Phase 4, complete. Those who understood the gold flow pattern in 1900 could see where monetary power was heading. Those who trusted in British permanence discovered that empires fall when gold leaves. The gold told the truth decades before official acknowledgement. 1958 to 1971. Gold drains from America to Europe. This example matters because it shows how quickly monetary power can shift when gold begins moving in earnest, even from the world's dominant economy. After Bretton Woods, America held approximately 20,000 tons of gold, over 70% of the world's monetary gold. The dollar was anchored to gold at $35 per ounce. American monetary supremacy seemed absolute, but cracks appeared quickly. By the late 1950s, European economies had recovered from war devastation. European nations held enormous dollar reserves accumulated through Marshall Plan aid and trade surpluses, and some of those nations began quietly converting dollars to gold. Phase 1, France in particular, began accumulating gold through dollar conversion. The accumulation wasn't hidden, but its significance was dismissed by American officials. Throughout the early 1960s, the flow intensified. Gold was shipped from New York to Paris to Zurich to Frankfurt. The refining industry processed American bars for European vault standards. Phase 2. The realignment was visible in shipping records and refinery reports. By 1965, American gold reserves had fallen below 15,000 tons. By 1968, below 10,000 tons. The vault drainage was dramatic, persistent, and accelerating. Phase 3, documented in Federal Reserve and Treasury records. American officials insisted the system was sound, the dollar was stable. Gold flows were manageable. The official narrative remained confident until it couldn't. August 15th, 1971. Nixon closed the gold window. America effectively defaulted on its gold obligations. The dollar devalued dramatically against gold over the following years. Phase 4. The transition was abrupt for those who hadn't watched the gold. In 13 years, America lost over half its gold reserves. The monetary system built at Bretton Woods collapsed. Those who converted dollars to gold before 1971 preserved wealth. Those who trusted official assurances lost purchasing power. The gold told the truth. The official narrative lied until it couldn't. 1999 to present. Gold flows from west to east. This example matters because it's still developing. The pattern is incomplete, but the early phases match historical precedent precisely. In 1999, Western central banks held the vast majority of official gold reserves. The United States, Germany, France, Italy, and other Western nations dominated gold holdings. Eastern nations held relatively little. That year, European central banks signed the Washington Agreement, coordinating gold sales to avoid disrupting markets. Western nations would sell gold. The implicit message, gold, was a relic, unnecessary for modern central banking. But as the West sold, the East bought. China began accumulating gold through multiple channels. Official reserves grew modestly, but Hong Kong import data showed far larger inflows. The gap between imports and reserve increases suggested unofficial stockpiling. Phase 1. Invisible accumulation hidden in the gap between import data and reserve disclosures. Throughout the 2000s and 2010s, Swiss refineries became the visible choke point. Gold flowed from London and New York to Swiss refineries. The refineries melted Western bars, 400-ounce London good delivery specification, into smaller bars, 1 kilogram, preferred by Asian buyers. Swiss export data showed consistent massive flows to Asia, primarily China and India. The refining realignment was documented in monthly Swiss customs reports. Phase 2. Visible, tracked, but rarely discussed in mainstream financial media. Now we're watching Phase 3 develop. London Vault holdings have declined substantially. COMEX registered gold fluctuates amid delivery demands. Central banks, primarily Eastern and Global South nations, are buying at the fastest pace in decades according to World Gold Council data. Phase 3. Vault drainage is occurring, documented in LBMA and COMEX reports. Phase 4 hasn't occurred yet. The monetary transition hasn't been announced. China hasn't revealed its full gold holdings. BRICS hasn't launched a gold-backed currency. But if historical pattern holds, the gold migration tells us where monetary power is heading. The gold is moving east. The mystery is whether it is moving. The mystery is precisely how much has arrived and what it means when official reserves are finally disclosed. Now let me show you the specific data that creates the mystery, the documented gaps that no official source adequately explains. The Swiss throughput data. Switzerland imports approximately 2,000 to 2,500 tons of gold annually, according to Swiss customs. Much of this comes from the UK, which exports gold primarily from London vaults. Switzerland exports similar quantities primarily to China, India, Hong Kong, and other Asian destinations. The Swiss are melting Western bars and recasting them into Eastern specifications. The throughput is documented. The scale is massive. Over the past decade, Swiss refineries have processed over 20,000 tons of gold. Most of it flowed eastward. The London drain. Bank of England vault reports show persistent decline in gold holdings over extended periods. LBMA vault data shows fluctuations that suggest outflows during high demand periods. The gold leaving London is documented. Where it arrives is partially obscured by incomplete reporting from destination countries. The Chinese mystery. China officially reports gold reserves of approximately 2,260 tons as of recent disclosures. This would make them the sixth largest holder. But consider the import data. China imported over 1,500 tons of gold through Hong Kong alone in peak years. Mainland imports through Shanghai add to this figure. Chinese gold mining production, which stays domestic, adds further. If you aggregate Chinese imports over the past 15 years, conservatively estimated at 15,000 plus tons, and add domestic mining production of another 3,000 plus tons, China has absorbed approximately 18,000 or more tons of gold. Some went to jewelry demand, some to private investment. But industry analysts suggest that significant quantities are held in accounts not reported as official reserves, possibly through state-owned enterprises, sovereign wealth funds, or other government-linked entities. The gap between what we can document entering China and what China officially acknowledges holding is the core mystery. The BRICS accumulation pattern. China isn't alone. Russia has tripled official gold reserves since 2006. India's central bank has been a consistent buyer. Turkey has accumulated significantly. Poland, Hungary, Singapore, and others have added to reserves. The World Gold Council reports that central bank gold buying has reached multi-decade highs in recent years. But official reserve increases don't fully account for the gold leaving Western vaults. Someone is accumulating gold that isn't appearing in official reserve statistics. The scarcity indicators. Physical gold markets are showing stress that suggests demand is testing available supply. Delivery delays from major vaults extending beyond normal timeframes. premiums for physical gold exceeding normal spreads over spot prices. Persistent backwardation in gold futures at times, where spot prices exceed futures prices, indicating current demand exceeds future expectations. COMEX registered gold, the metal available for futures delivery, sitting at historically low percentages of total inventory. These indicators suggest that the paper gold market, which trades multiples of available physical supply, is facing strains. The reporting gap. Here's the fundamental mystery no one adequately explains. If Swiss export data shows thousands of tons flowing to Asia annually, if China reports official reserves far below cumulative imports, if private demand doesn't account for the discrepancy, if no other nation claims the gold, where is it? The gold exists. Physical metal doesn't disappear. Serial numbers are recorded at refineries. Bars are inventoried. But the trail becomes opaque at precisely the point where visibility would reveal who is accumulating, how much, and why. The mystery isn't whether gold is leaving Western vaults. That's documented. The mystery is who holds it now, why they're not disclosing, and what they plan to do with it. Now I know what some of you are thinking, and I want to address those counter-arguments head-on. First, but jewelry demand explains the discrepancy. Asians buy a lot of gold jewelry. That's true. India and China have massive jewelry demand, and that accounts for a huge amount of gold absorption. But here's the thing. Industry analysts, like the World Gold Council, track this. They break down demand into jewelry, investment, central banks, and technology. And even when you add all those reported numbers up, there's still a gap. A big one. The jewelry argument just doesn't fully solve the puzzle. What about China's official reserves are accurate? They follow IMF standards. Well, yes and no. Nations report reserves, but IMF guidelines are flexible. Gold held by state-owned companies or other government-linked funds might not be counted as official central bank reserves, even if the government effectively controls it. So China's official number might be technically accurate while massively understating the total amount of gold the government actually controls. Another common one. If there was a real mystery, the financial media would be all over it. Media does report on these things, but usually as separate stories. You'll see articles about Swiss gold flows, or London's vaults shrinking, or Chinese buying. What's missing is the bigger picture, connecting the dots to see the aggregate flow and what it suggests about a global monetary transition. The individual stories are out there, but the full pattern is rarely put together. And finally, my favorite. Gold doesn't matter to modern finance anymore. Really? Tell that to the central banks buying it at the fastest pace in decades. Tell that to the BRICS nations who are openly discussing gold-backed payment systems. And tell that to China, which has absorbed more gold in 20 years than the entire U.S. Treasury holds. Official statements might dismiss gold, but their actions tell a very different story, and actions always reveal true beliefs. So, what does this all mean for you practically right now? I'm not a financial advisor, so I can't give you investment advice, but I can share what the data suggests. First, understand what gold movement has historically signaled. Gold flows from declining monetary powers to rising ones. It happened before Britain's decline, it happened before the US left the gold standard, and it seems to be happening again. You don't need a crystal ball to see that gold flow has historically predicted the direction of monetary power. Second, recognize the difference between what officials say and what institutions do. They say gold is irrelevant, yet central banks are hoarding it. Who are you going to believe? The people talking, or the people whose actions reveal their real expectations? Third, consider what the secrecy itself tells us. If nations are quietly buying tons of gold, they're preparing for something. They wouldn't spend billions on an asset they think is worthless, and they certainly wouldn't hide it if it were irrelevant. The secrecy screams significance. Fourth, look at your own positioning. Most Western investors have little to no gold. Meanwhile, central banks collectively hold about 20% of all gold ever mined. That gap between what the institutions are doing and what the average person is doing is huge. Fifth, watch the indicators yourself. Swiss export data, London Vault reports, World Gold Council updates. These numbers show whether the trend is accelerating or slowing down. And sixth, remember that mysteries eventually get solved, often suddenly. When the full story comes out, the market impact could be massive. If this analysis was valuable to you, subscribe to The Silent Economy and hit the notification bell. In my next video, I will break down exactly what a Chinese gold disclosure might look like and what specific scenarios you should be prepared for. Drop a comment below and tell me what you think explains this mystery. I read every single one. So here's what I want you to remember. Gold is leaving the West. It's flowing east, and it's arriving somewhere that isn't fully disclosing its holdings. Maybe there's a simple explanation. Or maybe, just maybe, it's the largest monetary positioning operation in history. History shows that the gold knows something long before the headlines do. The gold that left Britain predicted America's rise. The gold that left America predicted the end of the gold standard. The gold leaving the West today might be predicting what comes next. You don't have to solve the mystery, but you should know that it exists. The gold is moving, the destination is obscured, and the implications are potentially enormous. Thanks for watching The Silent Economy. Remember, the most important movements in financial history weren't announced. They were discovered by those who wondered why the gold had moved. The choice to pay attention is yours.